Hello, ladies and gentlemen. Welcome to my beginner-friendly introduction to trading. This is part one of a series on how to day trade. Now, part one is very basic, so we'll be going over three components. The three pillars of success are fundamentals, technicals, and psychology. Now, every successful trader must master these three things. Fundamentals are the things that move markets, such as news. Technicals is the ability to analyze charts, and psychology is the ability to stick to your plan and manage yourself. So, in part one, we'll go over fundamentals. Owning a stock means that you own a small share of a company, right? So, it's important to understand what moves a stock. So, this can be broken down into two fundamental components. The first is price moves from things such as news. So if, for example, politicians come up with a new law or regulation, or the president tweets about something. The second component is earnings. So earnings are the financial reports that the companies come out with every quarter. And the third part is sentiment. So investor sentiment can move market. Do people think the economy is doing good? Do people think the economy is doing poorly? Do they want to take out some of their money or add money into the markets? Now, the second component is macroeconomic factors. So, what does this mean? This is things such as interest rates. Interest rates change every so often. They go up, they go down. This will affect the price of stocks. High interest rates is typically bad for investors. Lower interest rates typically stimulates the economy. Things such as inflation. High inflation puts pressure on people, which means they cannot spend as much money or their money cannot buy as many things. And employment. So, are people employed? Is there a lot of people that are unemployed? So, these are all the key fundamental things that will affect the price of a stock. Second, we go into technical analysis. Technical analysis is a little bit more complex. Technical analysis is the analysis of charts. It attempts to forecast price movement using the past. It mainly involves the analysis of price, volume, and patterns. Now, what are those three components? What are price, volume, and patterns? Well, it's important to understand that price can act as a magnet or a deterrent. A price can seem expensive or it can seem cheap. If it's cheap, people will be looking to buy, and if it seems expensive, people will be looking to sell. So price can either act as a support or a resistance. Support meaning that people will start to buy at a specific price because they like it, so they will support the price. And a resistance means people are selling at that price, meaning the price is having a hard time to move higher, right? Now, when it comes to volume, volume is very important in day trading because volume indicates that there is interest by market participants or lack thereof. High volume equals many participants, and low volume is the opposite. If there is a lot of volume and the price of something is moving up, that means a lot of people are jumping in at the same time. Likewise, if there is a lot of volume and the price of something is going down, that means a lot of people are looking to sell at the same time. Technical analysis, part two, patterns. So patterns can be described as shapes formed by one or multiple candlesticks on a chart. In order to identify these patterns, you must learn what they look like on a chart. We'll go over that on the next slide. These can be quite discretionary though, right? Examples of these patterns will be something like a head and shoulders, a flag. So you may have heard some of these terms before, right? If you notice here, starting from the top left, we have something called a double top. To the right of that, we have a head and shoulders pattern. Then below, at the bottom left, we have a double bottom. And to the right of that, we have an inverted head and shoulders pattern. As you learn these patterns, you'll notice that they tend to reproduce. They reproduce on different time frames, different assets, and the outcome can be quite reliable if traded adequately. So again, these are just a few examples. This is not something that is perfect. It's not a science, right? This is more of an art. Over time, you learn to identify them on charts because they won't look as perfect as they do on these images. And then the third and final factor is psychology. Psychology is often overlooked, though, in my opinion, it is the most important factor in trading. In trading, psychology refers to the ability to stick to your plan regardless of how you feel. In my opinion, psychology is the number one reason most traders fail. A trader with mediocre strategy and great trading psychology will have success. On the other hand, even the best strategy and poor trading psychology will result in losses. Also, when money is involved, people tend to become emotional, and this results in poor behaviors. We often tend to see things like overtrading, revenge trading, chasing, impulsive trades. All of these can be lumped up in one thing, just poor risk management or poor trading psychology. What does this mean? If you get upset that your trade didn't work out and you right away jump into a next trade while you're still upset, this can be considered revenge trading. You should typically wait till you cool off, till you're at ease, till you're less emotional and more rational so that you can take proper decisions. Trading is not something that should be rushed. In the long run, the results of all of these bad behaviors are the same: losing money. In sum, in order to become a great trader, you need to master these three things. If you're a beginner, I would highly recommend you focus on trading psychology first. Even the best strategy, once again, even the best strategy with poor trading psychology will result in losses. Oftentimes, people focus only on the strategy and nothing else, but their ability to execute it is subpar. This, once again, will result in losses. I hope this was insightful. Thank you for tuning in. In my future videos, you can expect to see more elaborate breakdowns, more intermediate and more advanced content, more in-depth details of what moves markets, how to do fundamental and technical analysis, as well as a in-depth breakdown of trading psychology and risk management, as they are closely tied in to one another. Thank you for tuning in. Have a good day.